Right now, with the last OCR cut of 25 basis points yesterday to 3.25%, rates are heading lower at last. Every mortgage holder in New Zealand has a choice: coast on autopilot with standard repayments, or master the mechanics that could save you decades and tens of thousands of dollars. Most people think paying off a mortgage is simple. You just make your payments, wait 25, 30 years, done. But the smart money knows better. They understand mortgage architecture, interest rate differentials, and risk and debt recycling strategies that turn mortgages from financial anchors to wealth building tools. Over the next 30 minutes, I'm going to show you how to optimize every dollar you put toward your mortgage, whether you're carrying a 500K mortgage or a $1.5 million debt. These strategies work at any level, and the math is about to get very interesting in your favor. Let's turn your biggest debt into your smartest financial move. So there is a lot to cover off today. I will talk at pace. My webinar length usually 1 hour, so I'm going to be super punchy today and make it really relevant to your situation. We've had some great questions already submitted. We'll cover that off at the end. There's a wee Q&A box at the bottom of your screen. Ask me anything, just here to help. Fire them through, and my amazing producer will collate them and we'll go through them at about 10 to the hour, so in 20 minutes. But first, I'm going to go through mortgage realities in New Zealand, where we're at the moment, the real levers to get you ahead, how to build wealth through leverage, and then we'll wrap up with your questions so we can be as specific and clear as possible. So, who am I to be telling you what to do with your money? So, my name is Katie Wesney. Background is I'm a chartered accountant. I trained at KPMG. Feels like 3 million years ago now. And I'm also a qualified financial advisor, and I'm the head coach at Enable Me. So, I have worked with amazing clients, but I also coach our amazing coaches who are nationwide. Um, I've been here for the last decade. There's nothing I haven't seen. I'm also a media commentator and a staff columnist. So that is me. And my job essentially is to get people where they want to be in the fastest possible time with the least amount of effort. And we always need to ensure that you know that this presentation is provided for information purposes only. The content of this presentation is not intended as a substitute for regulated financial advice. I'll go through core principles I think you should execute on in terms of your mortgage, but as always, it's catching what's relevant to you. So obviously, I'd really encourage you to reach out to a qualified advisor. And to that end, I have a wee super special for those on the webinar today. So let's understand where we're at the moment. We all want financial security. It gives us choice. It gives us stability. It gives us more options in terms of the work that we do. And it also gives us peace of mind. In terms of plan design for my clients, generally speaking, our anchor or our core goals are around two things: financial freedom, having a little bit more choice around the work you do, how long you work for, and that security piece. People do not want to worry about money anymore, and your mortgage strategy is critical to what comes next. It really is. And if you are feeling the pinch, please know you are not alone. 49% of New Zealanders' income is going towards their mortgage. 59% of Kiwi mortgage holders are experiencing mortgage stress. Interest rates are coming down great, but what does that mean for us? And average first home mortgages have increased from 300,000 to 550,000 within the last 10 years. That is a really short window of time. And I know some of you watching today are looking to buy your first home from the questions submitted. We're going to speak to that soon. And I think that we're being increasingly exposed to really scary headlines 24/7 in terms of tariffs, high inflation. We just had the budget. What does that mean to us and our household wallet? Um, I've got three children. I don't know about you. Every time I go to the supermarket, I feel like I'm bleeding money. There is pressure around jobs with high unemployment rates, talk about recessions, hopefully coming through that. But again, lots of risk in terms of that external environment. We're now more interested in terms of OCR announcements over the last couple of years, and we just had our last one yesterday. What does that mean for you? And I'm going to call out a central truth, and there's always hope. And that's why you're in this webinar, because you want to know how you can repay your mortgage faster and not add to those figures from earlier. And here's how you do it. Inflation costs you more than you think. Questions we might ask ourselves currently: is now the right time to start? I'll speak to that. There's never a better time to start than today. I think that lots of people wait for perfect timing. There is no such thing. Best time to act is today. And we're going to speak to that in terms of mortgage environment, because lots of people are waiting for the bottom of the interest rate cycle. And I'm going to challenge your view on that in the session today. Um, can't I figure this out myself? You certainly can, but sometimes it will take you longer. You miss your window to act, and potentially having an expert in your corner will mean that you make faster progress and less stress overall. Should I wait until the economic turbulence dies down? I'll be waiting for quite some time. And if you've listened to anything I have written, any of my podcasts, webinars in the past, this is about controlling the controllables, what you can do every day to make yourself in a better position. Really important. Yes, you could wait, but understand what is the opportunity cost for you to do so. And again, I think this is so important to catch. If you catch nothing else other than this point, getting ahead is not about timing an interest rate drop or waiting for the economic environment to improve. Instead, focus on crafting a strategy designed to increase your savings rate, optimize your mortgage structure, and unlock future wealth creation opportunities. There's hope always, and that's why you're in the webinar. So that's what we focus on. What are your controllables? So very clearly, your controllables, cut through the noise. We're going to stop listening to that and focus on what you can control. And part of that is understanding your starting point. Determine what is the problem you're looking to solve. And often defining that starting point is as simple as sitting down and understanding cash in, cash out. Is there money left over? Look through your bank statements for the last few months. That is a great starting point. And if there's not money left over, if you are going backwards, that's the first thing we have to fix. If that money left over is any less than 15 to 20% of what's coming in, that's an issue. If you are wanting to buy your first property, if you are trying to get mortgage free, if you're trying to grow wealth, let's really understand what is the problem we're trying to solve. How quickly could you pay off that mortgage? Is there a gap in terms of retirement? We want to get really nuggety and laser focus in terms of goal, and that length of time you have to solve said problem is really important, because that will dictate where we lean from a strategic perspective. If you have time and you have access to equity in your home, that might be, well, should we be looking at purchasing another property as part of that wealth creation strategy? If you have less time, maybe that's, you're getting close to retirement, maybe we're leaning into managed funds. But cornerstone is you need to have a really good, strong mortgage structure and strategy, and understand how your behavior feeds into what you achieve, because that's really important. 80% of financial success comes down to how you behave around money, 20% around strategy. And at Enable Me, we try and marry the two to really maximize the pace at which you make progress. And in terms of controlling those controllables, there's three things I really want you to be laser focused on. Firstly, you need to maximize what's left over in terms of savings. Cash is the engine room of anything that comes next. You say you want to get mortgage free on your property, great. Well, you need money left over to chuck at that mortgage to increase the pace at which you pay it off. So that's the first place we start. You want to crush your mortgage, you just want to get rid of it as fast as possible. Love that, I agree. And that third place is that we want to focus is as we pay down that debt, we are creating equity that we need to think about. Should we be tapping in and leveraging off that to build wealth? And lots of people think that they need to potentially pay off their entire home mortgage before they look at growing wealth. I couldn't disagree more. For most of my clients, including myself, it's a concurrent strategy where you clear debt and grow wealth at the same time to land where you need to. And very easy for me to say, maximize your savings. How do you do that? We know on average people in New Zealand fritter about 15% of their net income. Do the calculation. What's coming into your bank account? Times it by 15%. I guarantee that is being wasted in terms of slippage. Where do you find that? For a lot of people, it's around food, in terms of the extra takeaways, trips to the supermarket. If you're anything like me, if I'm not being focused, if I go to the supermarket for bread and milk, I buy the buns on sale. Other things fall into my trolley and I've spent $80. I don't know how. So again, it's all of that inefficiency piece that we need to find and put to better use. In New Zealand, for a lot of people, you are paying too much interest because your mortgage structure is not optimal. So again, part of my job as a financial strategist with my clients and my team's job is to find that 15% that likely is not making you any happier. That's why we call it fritter, and we want to put that to better use. In terms of that better use and why you should be paying off your debt as fast as possible, you got to understand the maths around that. And I'm going to unpick that quickly in terms of an example. And if you are not doing this, please don't feel alone. Average time to pay off a mortgage in New Zealand is 30 years. So that's what everyone else is doing. Average first home mortgage of 550,000 on a mortgage rate of 4.99%. If you pay it off over 30 years, that will cost you 510,000. If you pay it off in 15 years, that 510,000 goes down to 231,000. Pay it off in 10 years, you pay 148,000. And you think about all of those things that you try and do to earn more money, to invest. Having that solid strategy around your mortgage is one of the biggest levers you pull to have more choice and grow wealth. Potential savings, 362,000 of interest you don't have to pay back to the bank. I don't know about you, but for me and my clients, we are very interested in finding that and putting that in your back pocket for sorting retirement or giving you more options into the future. And in terms of being really clinical around that mortgage structure, you have options. And what those options generally look like is you could refix for a certain length of time. And to be honest, the vast majority of people will do that. So your term will roll off, and then you'll think to yourselves, should I fix it for 1, 2, 3 years, 6 months? And that's the effort we put into structuring that mortgage. Another option we generally look at often is we refinance that lending from one bank to the other. That is a really important thing to be thinking about in this environment. There is lots of activity in the current market in terms of refinance. Why is that? For a lot of people, it is a chance to negotiate the sharpest rates in the next bank. Also, it's a chance to reset your structure. Also, that cashback can be really helpful. And sometimes that cashback is about 0.8% of your lending balance. And again, a sizable mortgage, that's a chunk of change too. And obviously there's fees in terms of conveyancing, etc. But that is significant in terms of progress thereafter. And lots of people look to restructure that lending. And for me and my clients, that's really critical in terms of making sure that they land where they need to. So one of the tools that we use at Enable Me is we have a mortgage optimization calculation written by one of our professors at the University of Auckland and our founder, Hannah McQueen. It's like 8 pages of calculus. Most people's eyes glaze over at this point, but essentially what that does, it cuts your mortgage into savings or debt reduction goals. So every year you have a piece you can attack over and above what the bank wants you to do in terms of that normal kind of term. You channel everything else in terms of money left over, in terms of paying off a chunk faster than you would otherwise. For lots of my clients, and this is definitely with a good structure and a plan, my preferred or favored mechanism to pay down the mortgage, and that is via that revolving credit, which is a floating piece of your mortgage, like a really big overdraft account. As you have funds left over or savings, you can offset debt immediately, but you can re-access it going forward. I like it for 2 reasons. First reason being is I love that as you pay off that debt, if anything was to happen, you could re-access it. You know, if a car blew up, a kid got sick, without having to go back to the bank to ask for further funds if things change. I think that's part of your resilience going forward. And I think it's a really clever way to mitigate interest because you only pay interest on the amount outstanding, not the available balance to you. So for my clients, what would sit in there is what we could save over and above that minimum repayment plus any savings. Because again, in my mind, if you have savings, and it is really important to have a buffer, but why would you have savings in an account when you have debt? Because you always, generally speaking, pay more in interest on your mortgage than you receive in savings, and you pay tax for the privilege of earning less. So again, how do we be smarter in terms of mortgage structure and strategy? And every year we're picking off pieces over and above that minimum repayment. And for a lot of my clients, yes, they want to get mortgage free, but they also really want to maximize that position. So while they increase the pace at which they pay off debt, they're creating more equity that they can tap into to buy another property. Why do they do that? They do that because of leverage. And that's one of the wonders of personal finance. You put in your money, the bank puts in their money, and you keep 100% of that gain. Mathematically, that outperforms other asset classes, not because it's amazing, it's just because you've acquired a bigger asset that goes up in time, in effect. And mark my words, if your retirement gap is bigger than 300,000, you'll likely need to use leverage to bridge it. Again, just because you've got that leverage piece in the background. And I'll give you a quick example because we are rapidly running out of time because I think those examples really kind of bring this to life. And so for me and my clients, again, that mortgage structure and strategy, getting you mortgage free faster is important. Remember, for most people, they're on track to pay off their mortgage in 30 years. So for most people, that's about on retirement. For us, we want to do it faster. In this example, paying off that mortgage faster, it means that they have more time to save for retirement, etc. And in doing so, they extend the time that their funds will last through to 80 versus for a lot of people in terms of averages, get mortgage free by 65, great, an achievement, but their KiwiSaver only lasts a few years. So again, really shows you the importance of being strategic around this. And in this example, great, your money runs out at 80. But for me and my clients, I need to get them mortgage free, and for their funds to last at least to 90. That is the goal for my clients. In this example, there's a $500,000 wealth gap. For this client, they're buying another property. Goal is to hold that, and that will bridge that gap in terms of retirement. And again, just getting a little bit more nuggety in terms of those numbers. And again, 160,000 invested in managed funds, great return, 6% returns you 9,600 versus 160,000 as a deposit on an $800,000 asset. The return is much larger because again, just a bigger asset you've required. But as always, you've got to buy the right one and have the ability to hold it. Is now the right time to invest? And again, bank does not have an infinite appetite to lend you money. Often, if you can, you should, but getting the numbers right is really critical to being able to hold it. And you buying another property as part of your strategy, would that take your eye off, well, let's get mortgage free on that home as fast as possible? Certainly not. But again, we're not here to muck around, we're here to maximize. And there's lots of different options to grow wealth. But again, for us, we work on knowns and what are the biggest levers that will turn the dial for you and your family into the future. And I think often when we talk about strategy, that accountability piece is really important. You're at this webinar, I love that. But my challenge to you is it is great to know what to do. It's in the doing and the execution piece that will move the dial for you and your family. So reviewing everything, it's important to get mortgage free ASAP because it helps you reduce the interest you're paying to the bank and allows you to build equity in your home to grow wealth. Equity means more choice, etc. And how do you do this? Not with interest rates because they're uncontrollable. But again, interest rates are coming down. This is your opportunity not to be complacent, but to really move the dial. So the solution then comes down to maximizing that cash surplus, creating a plan and keeping yourself accountable to it. You can do that by speaking to one of our amazing advisors up and down the country, like myself. But here's the bottom line. Your mortgage doesn't have to be a 30-year sentence. It really doesn't. The strategies we've covered today literally saves years off that mortgage. The question isn't whether these strategies work. The math proves they do. The question is whether you'll implement them or let that opportunity slip by. Because interest rates, properties, they go in cycles. Interest rates will go up in the future. We know that. This is your time to take action. Your mortgage is likely your largest financial commitment. Doesn't it deserve just a little bit more strategic thinking? So here's what I'm going to do for everyone in this webinar today. I'm offering a comprehensive 90-minute financial consultation with one of our amazing qualified financial advisors and coaches. It's normally $400. I'm actually going to discount it down to $99 for those attending this webinar, but I'm going to put a caveat on that. You need to book that by close of play tomorrow, Friday. So we have a super special $149 that you, again, if you don't get to us in terms of booking by Friday, you can still take advantage of that $149 for the rest of the month. But that super special I'm offering you is only till close of play tomorrow. What we'll do is we'll analyze your specific situation, run the numbers on these strategies for your loan and advise key areas of focus. Knowing the theory is one thing, having a qualified financial advisor map them out to your own circumstances is what actually moves the dial. Now let's tackle your specific questions and make sure you leave here with clarity. Let's dive in.
Thank you so much for your time and sharing your expertise, Katie. We
Oh,
now have
good.
time for a bit of Q&A for our audience.
Great.
Thank you to
I'll talk
everyone who has
quickly.
sent your questions. You can still put them in the Q&A if you'd like to. So the first question I have here is, with ever increasing house prices and high mortgages, what is the best way forward for our young people trying to get on the property ladder?
Mm. And I think that really interesting, great question. First home buyers are actually the most active in the market at the moment. Why is that? We're seeing lower interest rates, and it really is a buyer's market. There is lots of supply. So challenges to act now, not later. I think for lots of people, this is good as conditions get. Kind of, we've got those predictable cuts, competitive banks. So it really does feel like a buyer's market. So I would recommend, if you could, that you get cracking and dive in.
Thank you. And second question, what would you advise is the best length of time to fix your rate for currently? This person says their fixed term ends in October this year.
Great question. So, in terms of OCR messaging yesterday from the Reserve Bank, target OCR still is between 2.75 to 3%. What does that mean? That means that there is not inflation or deflation, because that's a home base by late 2025. So we're getting really close to the bottom of the cycle. I think the opportunity window is narrowing fast. 1 year rates heading towards 4.5% by kind of springtime. I think we're almost there. I saw BNZ already announce 4.89 for 18 months. I think other banks are following, and longer term rates, we really think, and again, this is the caveat, we do not have a crystal ball, but again, information to hand, there's potentially limited downsides due to kind of global factors. And in terms of my clients, and again, this is situation specific, if you get anything under 5 for 2 years, you're taking it seriously. Lots of people are splitting loans, just again, hedging their bets in terms of, well, let's have a goal to clear within the next 12 months. Let's leave that floating in a revolving credit, and let's split the rest across term times in terms of risk mitigation. But my core message for you and for those on the call, do not wait for perfection. Honestly, the difference between 4.5 and 4.2, it's just not worth the risk, in my opinion. And I also think in terms of, for this person, that lending coming off fixed terms, you got to be thinking about that bank switching opportunity. As I said previously, high activities as kind of borrowers are chasing better deals. So really want you to be considering that as well.
Awesome. Thank you for that advice. Are you better off making lump sum payments on a mortgage or increasing your regular payments by a smaller amount?
Neither. And again, all not bad things, but in terms of, for my clients, they want to embed flexibility. So remember, we talked about, with a good structure and a strategy, ideally you lock in the vast majority of your mortgage in terms of fixed rates. So again, there's that certainty, where things are at. But I would say, if you have the ability to pay more, you figure out, well, what would that look like over a 12-month period? And I'd put that as a goal to clear within a revolving credit. So as you amass those funds, immediately you can offset debt. But I like that flexibility of you being able to reaccess if you were to lose your job or something was to happen. I think that's really protective. But the caveat to that is, have a plan, have control, because it's really easier to float too much. You pay a premium to float, generally about 1.5% higher than it is to fix. It still makes financial sense if you clear it, but the caveat is you clear it. So lots of people, again, float too much, paying a premium to do so. Lots of people attach a wee credit card to that, put all their spending on a credit card, overspend, pay it off, paying a premium again to the bank, and they don't make progress. So that structure and strategy around that is really important.
Awesome. Thank you. We'll have time for one final question. How can I best use my equity without causing more financial stress?
Such a good question. And I think that always having that underlying strategy, this is the foundation of anything you do, is having that really great debt reduction strategy attached to your family home. So you're trying to pay that off as fast as possible. If you have capacity to tap into the remaining equity to buy a property, ensure you buy the right one from a math perspective. So you need to ensure that you understand why you're doing it, which is generally for capital gain, but you need to make sure that the income coming in or the rent is such that you can keep the darn thing and it's not going to place too much financial pressure. And once you purchase it, you're still concentrating on paying off that home mortgage because that's going to de-risk you into the future. So it's always making sure that you have that clinical debt reduction strategy. You always focus on that unproductive debt attached to the home, and you make sure that the maths works out in terms of buying the right one that you can hold, because that's the risk mitigant. You never want your hand to be forced in terms of selling that property or other at a less than optimal time. That's the risk mitigation piece.
Thank you, Katie. That is all the questions we have time for today.
Oh, great
Sorry that we
questions.
can't answer everyone's
I'm
questions, but we do
sorry.
encourage if you have any questions about our financial consultations to email us via info@enabme, or you can scan that QR code, or you can call us at the number on our website. And I'll hand back over to you, Katie, to finish off.
Yeah, great. So I really hope that you have found this webinar enlightening. And again, it's catch what's relevant to you and just knowing all of this stuff. I mean, it's nice, but it's meaningful in itself. The key is taking action, and it's what I really encourage you to do. If you want to speak to a financial advisor like myself, scan the QR code, $99 instead of 400 before close of play tomorrow. I'll get my team to update that super special I've offered. And I wish you all the best for the future. Take care.